Hello guys, welcome back to our YouTube channel. In today's video, I will be breaking down how to read market structure the smart money way. This is fundamental to every high probability trade setup. Understanding market structure is like reading the market's language. Without it, you will be chasing price and lose trade with it. You can spot trend reversal, breakout and sniper entries. So let's get into it. So what is market structure? Market structure refers to the way price move on the chart and how it forms trends and patterns over time. Understanding market structure helps traders identify the current market trend, potential reversals and key trading opportunities. So there are three types of market structure, which is number one here, your uptrend, that is your bullish market structure, when price form higher highs and higher low. And again, number two, your downtrend, which is your bearish market structure, when price make a series of lower high and lower lows. And again, number three here, your range sideways market structure, when price does not have a direction, it keep ranging in a particular spot. So let me be showing you guys an example of an uptrend and a downtrend, then a ranging market structure. Let me list that out real quick. So when price is in an uptrend, it makes a series of higher high, higher lows, higher high, higher lows, higher high, higher lows, higher high, higher low, higher high, higher low. You can clearly see that this is an uptrend. Price making a series of higher high, higher low. This move right here is called an impulsive move. An impulsive move. While this other move here, this particular one from this spot to this spot, is called a correction move. This is an example of an uptrend, price making a series of higher high and higher low. You can clearly see that this is moving up. If you take your trend line and you draw, you can clearly see that it's heading to the upside. So this is a perfect example of an uptrend. Don't worry, we'll be showing you a live chart example of this. So what's number two? The downtrend is similar to an uptrend. This is when price keep breaking structure to the downside, making a series of lower low and lower high. It look like this: lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. This is an example of a downtrend, price making a series of lower low, lower. If you take your trend line and you draw this down, you can clearly see that it's moving downward. So as we said here earlier, this is your impulsive move. This will be your correction. This will be your impulsive move, your correction, your impulsive move to the downside, your correction, your impulsive move. So for you to be able to identify this market structure, is very important to know where price is headed and to trade in line with that direction. As I say, the trend is always your friend. You don't want to trade against market structure. If not, you will take a lot of losses. So I will be showing you shortly how to identify market structure and how to trade in line with the structure, and how to know if a market is shifting structure. So number three there is the range sideways market structure. It looks something like this. You can clearly see that the market does not have a direction. It keeps ranging between one particular spot. You can see no direction to the, is either going to the upside nor to the downside. It just in one particular spot. This is an example of a ranging market. So a lot of traders do not trade ranging market. It's not advisable for beginners. If not, you are going to take a lot of losses. Trading with the trend is always your friend. It's always going to make you a profitable trader, except you are an experienced or a pro trader. That is when you can trade the ranging market. So it's not advisable, for, in my own opinion, it's not advisable for a beginner to trade a ranging market. So why does trend matter? Why does market structure matters, especially in smart money concept? Why does it matter? Number one, market structure helps identify break of structure in the market and a change of character. Market structure is very important in smart money concept. Why? It helps us identify a break in market structure and a change of character, which means it helps us know that when a trend is reversing either to the upside or to the downside or a continuation. So number two, it reveals liquidity zone, entry point, and trend continuation or reverse, as we said before. So market structure helps you identify where liquidity zones are and where you can take your entry point. Don't worry, we'll be looking at a live chart example of that playing out real quick. So just sit back and relax. So these are the theory state of the market: the uptrend, the downtrend, and the raging market. The uptrend where price making a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, and higher low. And the downtrend, lower low, lower high, lower low, lower high, and the ranging market. So for beginner traders, any trader will tell you this is how price move, but that's not usually the case. If price move in a straight pattern like this, it will be very easy to make money off the forex market. But how do price really move with liquidity, incorporate with liquidity? Let me show you how price move with liquidity with it. As a smart money trader, you see price move like this. This is how, in an uptrend, this is how a price moves. Not just clear structure like this. Price can never give you a clear structure like this. Why? Because it will be very easy to make money. Anyone can make money. What do price do? Price give you a structure like this, leaving liquidity, leaving lows to be swept out, to be later taken out, to be used as liquidity. This is a higher high, higher low, higher high, higher, and a low. This is a low. This will be swept out later. So what do you do when you identify a break of structure and you see that price is in an uptrend? You identify a break of structure to the upside. Let's mark this out as a break of structure. A break of structure. And you see this present low here. What do? You take your box, you mark out the nearest demand zone next to it. This price, this low here, will eventually be swept out, where price move from liquidity to liquidity, key levels to key levels, and in doing so, taking liquidity next to it. Don't worry, in our next video, we'll be diving more on liquidity. So here again, you see this low here, price will come, use it as liquidity to get momentum to the upside, using the next available demand zone here to buy to the upside. This is how price really move, not just a series of higher high, higher low, higher high, higher low. In between this correction move, there's always liquidity. Price always leave liquidity to be swept out. Why? Because of early buyers and smart money traders and bank institution that is coming in to buy. So price have to leave liquidity to be swept out. Why? For momentum to be in the market for an impulsive move. Market structure, we know price make a series of higher high, higher low, higher high, higher low, higher high, higher lows, higher high, higher lows, higher high. This is your typical market structure. And take note, we have two types of market structure. We have your swing structure and we have substructure. If this is in a higher time frame, these are your swing structures. When you go to a lower time frame, each move here, take for instance this impulsive move in a lower time frame, is also an uptrend. You see something like this in a lower time frame. So in a lower time frame, this will be your substructure or your minor structure. While in lower time frame, it will be a swing structure. So in a 4 hour or a daily time frame, you might have something like this. Then this. As you know, we are intraday traders, so we are not swing traders. We don't trade with daily, weekly, or monthly. So we identify a swing structure in the higher time frame, then we come to the lower time frame to follow this structure. So we trade along with this structure. That's how we trade each move. So always keep that in mind when you come to a higher time frame, and you identify a swing structure, and you see that price has already made a higher high, something like this. Price has already made a higher high, higher low, higher high, higher low, and you see that price is going to make a higher high. So what do? You drop down to the lower time frame. In this case, price was making a series of lower low, lower high. In the lower time frame, lower low, lower time frame, lower. Then you have a sweep of this low here, then a break of structure. Then that's how you know that the trend is reversing, and the swing structure is going to make an impulsive move to the upside. So you start looking for buys. That's how you follow the. So once you identify a swing structure on the higher time frame, and you've discovered that price is in an uptrend, making a series of higher high, higher low, or in a downtrend, so you go to the lower time frame and you look for entries. Say for example, you come to the 4 hour time frame and you see something like this, and you say, oh, price is in an uptrend. You come, you take your trend line tool, and you see, okay, price is in an uptrend, and price is in this particular spot. In this case, this is an example. In this case, and you see price is in this particular spot. So what do you start looking for? Then you drop to the lower time frame. Then you look for a sweep of the previous low, a change of character or a market structure shift to the downside, a pullback, another break of structure, a pullback, and a sweep of that liquidity, and you target the swing high. That's how you enter into the market from the lower time frame. Don't worry, we'll be doing more on top-down analysis. That means we will start from the daily time frame to the 4 hour time frame to the 1 hour, then to the 15 minutes as your entry time frame. We will be dealing more on that on more videos to come. So this is just an example. So we will be diving deeper on more videos to come. So let's get back to this. So you see that we've swept this previous low on the lower time frame. We had a market structure shift or a change of character, a break of structure to the upside, and we had the liquidity here, which is this low, and we expect price to be taken out, and we expect price to take it out. So stop our entry below this demand zone nearest to it. Then we target this next high on the higher time frame, or if you don't want to hold it for that long, you can target this high here on the lower time frame. Then you are good to go. So that's how we follow the trend from the higher time frame to the lower time frame. Take don't forget, this might be a daily or a 4-hour or a 2-hour, then you drop to maybe the 1 hour, the 30 minutes or the 15 minutes to look for this setup here. Don't worry, in the next video I'll be showing my top 3 entry models, so you will get a better understanding of what I'm trying to say, a perfect clarity of everything we've said today. So that is it for swing structure and substructure. So let's take a look at this chart example. You can clearly see that price is in an uptrend. Why? Price is making a series of higher high, higher lows, higher high, higher lows, higher high, higher lows, higher high, higher low, higher high. What can we see? What can we see? You can see this low here and this high here. What is underneath it? A low. This will serve as your liquidity. And what the price did, price came back and swept it. Let me mark it here. You can see price broke to the upside here. Price broke to the upside, creating a break of structure, and left a low to be swept out. And what do you do as a smart money trader? You use this demand zone right here as your entry. You place your buy limit, stop below this low, and target this next high. That's the 1 to 3.4 risk to reward ratio. This is how price really moves in the market. You can see price does not give us a clear higher high, higher low, higher high. And take a look at this example here again. You see this price came back, gave us a lower low, lower high, and a higher high. What is in between? A liquidity zone that price left, a low that is going to serve as liquidity that will later be swept out. And what do? Use this zone. Yeah, this is an hidden base zone, a hidden order block. Don't worry, we'll be covering that on more videos to come. You set your limit here, stop below this low, you target the next high. That is another 1 to 3 risk to reward ratio. This is how price really moves in the forex market. Price cannot just give you a clear structure like this: higher high, higher high, higher low, higher high. No, price can never do that. You can see price did not do that here. But what did price do? Price came, gave us a higher high, a higher low, higher high, and a low. This low is going to serve as our liquidity. It's what's going to attract price down to this other block, to this your demand zone here. Price is going to do something like this, and here, and it's going to come back, then go to the upside. Don't worry, in more videos to come, I will be showing you my 3 entry models, how I enter the market, patterns I look for, trade setup I look for that I use to enter the market. I will be covering that in the next video to come. So let's continue. You can see price did not come this way, but it came into this imbalance here. It came into this imbalance, and price continued to the upside. Then what can we see here? This is what I'm going to explain. What can we see here? We can see that price was in an uptrend before, making a series of higher high, higher low, breaking structures to the upside. So what did that tell you? Why structure was important? 1, I told you it helps identify break of structure and change of character, and most importantly, reversals. You can see price broke the structure. What did price later do? It came back, break this structure, signifying a change of character or a market structure shift. It means price has shifted from an uptrend to a downtrend, because this structure here was supposed to hold. Price was not supposed to break through the structure, but price did not just break this structure alone, it also broke this. he also gave us a break of structure. This is signify a break of structure to the downside. So we start looking for sells. We don't start looking for buys. We don't focus on this side again, because if you keep focusing on here's a demand zone, let me use this space to buy to the upside, price is going to come back here and I'm going to buy from here. So what did price do? Price will that eventually come, tapped you in, and you may feel price is going up. What did price later do? Came back, dropped down, then came back again, continue to go to the downside. So you ignore this side completely, and what do you start doing? You start looking for sales. You start looking for sales. You can see the difference. You can see the let me mark it out. You can see the difference, how price shifts from a downtrend to an uptrend. So when you spot something like this, a change of character, a break of structure to the downside, you start looking for sales. You start looking for sales. What do? You start identifying a current break of structure. For example, you can see price broke the structure here. Price broke the structure here. Broke it to the downside again. What do? In this case, you use this demand zone you set a limit here, stops, is it 27 tip stop loss, target your next low, boom, TP hit. Then you start looking for sales. What can we see here? You can see this liquidity zone here. Your demand zone here. And set your sell limit here. Stop slightly below this high. Target the next low. As a smart money trader, always follow the trend. And what can we see here again? A change of character. You can see from here, price reversed from a downtrend again to an uptrend. So you stop looking for sell, then you start looking for buys. How? You look for a break of structure to the upside. You can see price left this low here as liquidity this week, as liquidity. As liquidity. Then this hidden base order block, which I will be explaining in more videos to come. What do? Stop limit here, stop slightly below this low, and you target this next high. That is a 1-to-7 risk to reward ratio. This is how you follow the trend. If you keep going, you can see price also change market structure here. So that's how you follow market structure. That's how market structure helps you become a better trader. Let me give you an example of a ranging market. So this is an example of a ranging market, though not a clear one, but I think we can make use of it. You can see prices keep giving us high, lows, high, lows, high, lows, high. No clear direction. So the market is also called choppy market. You can see no clear direction. Price just keep making a series of highs and lows, highs and lows, highs and lows. So this type of market you want to stay off. If you're a beginner, you just want to stay off. You don't want to trade. You don't want to overcomplicate things. So you stay off a raging market. You follow a clear structural trend, either an uptrend or a downtrend. So that's it. Let us recap everything Let's recap everything we've said. So what do we say market structure is again? This refers to the way price move on the chart and how it forms trend and pattern over time. Understanding market structure helps identify current structure and potential reversals and key reversal opportunity, as we have seen from all the chart examples I've presented to you. And what are the three main type of market structure? We have the uptrend market structure, where price make a series of higher highs, higher low, highs and lower lows. Then a downtrend, where price make a series of lower lows and lower highs, lower low and lower highs. And the raging market, where price make a series of highs and lows with no clear direction. So we've seen how market really moves in terms of market structure and liquidity. And we said again, why does market structure matters, especially in smart money concept, and also we also dealt with that. Market structure helps identify break of structures and change of characters. It also reveals liquidity zones and entry point, as we have seen here and in live chart example, liquidity zone and entry points. So I hope this helps you, and we'll be diving in more on liquidity on the next video and entry models. After our liquidity video, we'll be diving in on entry model. I will be showing you my top 3 patterns I use to enter the forex market and how I execute my trade. So stay blessed. God bless you guys. Don't forget to like, share, and subscribe. I'll see you on the next one.